Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, June 29, 2022. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, interestingly enough, we had one of those weird quote-unquote markets today. However, what we're going to do is pick apart the tape, look at a variety of different charts, and I'm going to explain exactly what I'm seeing, including the numbers on both sides of the tape. What keeps the bullish side from running? What keeps the bearish side from coming down? What we had today, and I'll get to the 379.85, that's the fuchsia horizontal line running across the screen. What we had today was called a convictionless market. Conviction was absent. We'll start with the range of today. The high of today was 382.27. The low was 278.42. Now, on a normal garden variety day, that's not too bad. However, with the expansion of volatility that we have, it's a very narrow ranging day. So hence, the market essentially didn't do anything. It didn't get anywhere. However, the question is it telling us anything? And that's what we're going to pick apart in this video. Remember, we have a holiday type of market. The closer we get to the end of the week, the more light the volume would become. And even though too many traders know about it out there, there is a seasonality bullishness thing going on between now and let's just say into the second week of July, or at least through the first week of July. Doesn't mean the market goes up every day, but it's a bullish time of the year from a statistical standpoint. Doesn't mean it works every time, but when you look at it, you'll see that almost 8 out of 10 times the market rises between now and into the second week, or at least through the first week of July. That coincides with the old 3-day holiday weekend bullishness thing going on. What's the flip side of that, by the way? The flip side is the trend. The trend is down. The trend is your friend until it's over. From a short-term perspective, could the trend have ended here, and could we still get another rally leg higher? And the answer is yes, we can, but we're going to look at the bullish side of things using some other charts. So we'll uncover some detailed information about the downside. Let's take a look at a couple of other things on the daily chart that are extremely important. So Friday we had the big up day, and yesterday they got below and closed below the low of that big breakup candle, 381.37. They tried to recapture it a number of times today. We're not able to do it, and being below that number opens the door for the gap down at 378 and change. Now, here's where things begin to get really interesting. The low of day today is 378.42. Now, we've been here before. We've had this discussion before using a different chart setup, a different point in time, different numbers, but it's the same circumstance. So they had an opportunity to fill the gap today, and they didn't. So what we're saying is either they couldn't do it, the bears couldn't push price down another 40 cents, give or take. Now, I find that one hard to believe. There are no accidents or coincidences, so the interpretation is twofold. It goes either or. So here we go. Either the market isn't going to fill the gap right now, and it's going to trade away back up in the northern direction. The gap is unfinished business. Now, in my estimation, if they were going to do that, they would have done that by the end of the day today. The second option is the gap isn't really the destination. By not getting there today when they could have, they're telling us either the tape is that bullish or they're going lower to a different destination. Based on today's activity, there's no indication that the tape is actually that bullish that they couldn't get to the gap. Maybe we wake up to a big gap higher opening in the morning. That's certainly possible, but that's not what happened at the end of the day today. So we go with option B, which is the bearish scenario. The destination is actually lower. And now what we need to do is find where is that destination that would lie beneath that gap at 378 and change. Remember the 240 chart from last night? We talked about the 20-period moving average. They never got it today. They hovered over it and began to run sideways a little bit. Again, supporting the case that the destination is really lower than the gap at 378 and change. 120 chart is really just a stretched out version of the 240 chart. Same routine. They're hovering over the gap. How about the hourly chart? Here you see that they ran into, or at least ate time off the clock until this convergence existed between the 50 and the 100 period moving average. They really couldn't get above the 100 period moving average all day. Same routine on the hourly chart. Again, just a stretched out version of the 120 and the 240. They were eating time off the clock above the gap. That's the underlying theme that we take away from today's activity. Now, I've put another line on the chart, 374.65. Maybe it's 375. I think they spike 375. There's another number slightly above 375 that's also important. It's right around 375.20. So we'll call it a zone between 375.20, 374.65. I would put those two on a sticky note. If we find the market trading down there in the morning, not opening below that area, that opens up a different can of worms. But if they trade down to that area tomorrow morning, Thursday morning, there is likely a buy opportunity in that zone. Now, getting much below 374.65 and closing candles below there tomorrow will open the door. This is an if. If they did that, that will open the door for a trip down to about 370, give or take. Write that down on a sticky note. Now, let's talk about the other side, the flip side. You wake up, they're in the same place, maybe slightly lower, maybe slightly higher, but they end up trading higher tomorrow morning. Where are they going? What are they attempting to do? The first thing we know is that markets love to start to climb up these big breakdown candles. So yesterday's big breakdown candle, if they can begin climbing up that candle, it opens the door for some numbers like 383.50, which you'll see in the notes today from Inside the Numbers. There's some other numbers before that, but the big time number would be 385 to 385.75. Much above that opens the door for the high of that breakdown candle. Again, I'm giving you a lot of information that's normally found inside the numbers. But tonight, I feel like giving you the numbers ahead of time. Speaking of numbers, let's go inside the numbers. We'll start with the commentary. We'll run through some important things. As you saw, it was a relatively narrow-ranging day. They were in a quote-unquote chop shop formation all day long, but there's some important stuff in here. We'll run through it. We'll highlight it. We'll circle back to stocks on the move. It was hump day. Wake up a little red as the bears are looking for a little bit of follow-through to the downside. Now, this is at zero dark 30. 379.75 is the pivot and will tell us what our expectations are for the next few days. Meaning, below that, we've got the lower stuff, above that, and they'll try and bounce the tape. They're either running a test of an important number while making it look like a real failure, or it's not a test in favor of much more downside coming today and beyond. So we didn't have the downside today, but we had the test. Now, it's an important number. It's a really important number. It's so important, and this is how I know how important they are. When I sat down this morning at the screens and I started going through stuff, it took me all of about a minute and a half to find 379.75. It slapped me in the face as if I pinched her in the ass. So testing it for an entire day, which is really what happened, is not out of the ordinary for a number of that stature. We had the lower stuff on the board. They never got to the 378. We know about that. And then we had some higher stuff on the board, We had 381.50 up to 383.50. There'll be some more numbers that show up from a short-term basis as we scroll up the notes. Let's get our faculties. 5-minute chart. Right of the vertical is today's activity. Your range at 0 dark 30 already was 379.85, 381.50, and as you can see, other than a few spikes here and there, that essentially were the two numbers today. So therefore, we're moving right along. Early on, we're talking about the pivot. The pivot is important. If they start pushing higher, 383.50 is on the board, 382 to 383.50 is a zone. Now watch this. 925. 383.50 is a key spot from a short-term perspective. It's just a bounce in a downtrend unless they're closing above that number. If they're closing above, that's one thing. But if they can't get above, there should be a test of 379.75. Now, by the time this rolled around, they were already in the green. So what I'm saying at 925 is they're going to come back to run a test of this important number. It's a pivot. It's a sell the rip tape, but they'll bounce around at the open and make it look like one thing before doing another. 382 to 383.50 is a zone of overhead resistance. Both numbers are important, which makes it a zone. Traders can short both. Back to the chart, you can see I moved the line up to 382. They never got to 383.50. This was the front end of the zone. So what happened later, and you'll see this in the notes, is I raised my price that I was willing to short the tape at. Doesn't mean it's not an important number, but what happened was they came close, they pulled back a little bit, went back up. So when they do that, I err on the side of conservativeness, and I raise my number a little bit, but other traders were happy to take the short. What did they do? They ran a test of the pivot as prescribed in the pre-market notes. How you doing? Let's scroll up, see what else we have. Read the notes. Go back to the chart to double check the work. You know it was in a tight range. You know what the numbers were. They're going to keep repeating over and over and over again. So I urge you to read the notes and double check what we're saying and if what we're saying is happening on the charts. Look, 1040, 382, 379.85. It's a range they stayed in all day long. So you know the routine. I'm going to give the commentary. I'm going to be the tour guide. But by the end of the day, you know what happened already. So I don't have to belabor the point. If you're interested in being an intraday trader, already are an intraday trader with the S&P or one of the vehicles that tracks the S&P, whether it be options, exchange-traded products, futures, micro futures, it doesn't matter what it is. This is tour guide information. I'm giving you each and every day the golden goose. How about stocks on the move? We had a laundry list this morning. A couple came close. They bounced away. The market was in a chop shop all day, so things just didn't get to their numbers. Goes into that weird camp. We'll see what happens tomorrow. My expectation is, and this is the night before, I think we're going to get a bigger move tomorrow. Today was more of a way station type of day. One of these stocks hit its number, RCL. This goose happened to have laid an egg. The egg turned out to be a shitburger only because they kind of did some Macarena stuff around the second number. If that didn't happen, it might have been a different scenario. They came up short, prevents the second number from acting and reacting the same way. They go down to the third number. They bounce around, but they never recover. So the first number was totally wrong. They never made it back. So this ended up to be a shitburger. It happens. We're in the risk business. We understand how this works. We can't win every trade. We win the large majority of the stocks on the move trades. Sometimes we're going to get handed one that just doesn't work. Today was the one that doesn't work. I'm an open book. I'm okay with taking a look at the good, the bad, and the ugly. What bothers me is when traders only show you the stuff that worked, giving you the false sense that everything works, and it doesn't. This is a probability business. What's going on over in Camp IWM? So they filled the gap bounced off the gap, closed above the gap. That's okay. It's not bullish. It's not bearish. They're in a downtrend. That's bearish. They made a bearish wedge pattern. That's bearish. So they filled the gap. Now, tomorrow, if they're bouncing, that's one thing. Maybe they can get back into this big breakdown candle. That's item number one on one side of the ledger. The other side of the ledger is if they get below that gap, where are they going? 168, give or take, might want to put that on a sticky note. Below that is a real-time type of thing. Get out your sticky note for a second. Here's the weekly chart. I want to point something out that we may not have talked about in several days, which is what is the unfinished business for the IWM? 161, and there's also lower numbers, but that's the front end of a number or a zone that was left untouched, unfinished on the last run down. So here, as you can see, again, below all the moving averages, beginning to put in one of these bearish, wedgish, flaggish type of things. So whether it happens for another couple to 3 weeks or not remains a mystery. But ultimately, until and unless they can get above here, this is a bearish formation. Put that on a sticky note. Now, 161 certainly is unfinished business, but because they came close from a weekly chart perspective, I'm not saying there's a trade at 161. I'm saying that's a target if they start to fail. So meaning I'm not looking to trade 161 on a touch back to the upside. I'm saying it's a target on a failure on the downside. What about the folks down at the transportation department? What did they do today? They did something very familiar. They ran a test of the most recent breakup candle low. They bounced away. Fair enough. Can they get inside yesterday's breakdown candle? It remains a mystery, but that's the next order of business for the bull case. The bear case is they have to get below the breakup candle low, which is at 13,065 and change, and they have to spend some time down there, close candles down there, close hourly down there, daily down there. Then we're looking at a bona fide failure. What about the Q people? Anything interesting with the Q people? Not really. The only thing that catches my eye on this chart, other than the downtrend, is the fact that they closed above yesterday's closing price, which was near the low. If someone were to be bullish and they were looking for a hint, a very small hint, that would be the one. As far as the 120 chart's concerned, there's a couple of things. We've got somewhat of an on-time situation with a sign or signal of a trend change. They're hugging the 50-period moving average, and they closed above that daily number we just discussed. Okay, fair enough. Back to the SPY for a moment. I want to compare and contrast something with you that we just went over in the Qs. Now, this is another on-time situation, another sign or signal of a trend change on this hourly chart. It was what I called in the notes today and to the live room members a full stack situation. Couple of things happened. They never closed below the low of this tail candle. The second thing is they never really bounced up more than to the top end of today's range. Technically, it's still active leading into tomorrow, as long as they don't close below the low of the tail candle. The low is 378.42. Now, if they get below, we have that story. But if they're bouncing away, then the full stack from today in the SPY and the 120 chart on the Qs we just looked at begin to look even more interesting than they are right now. Sometimes it's like turning a battleship in a bathtub. Keep in mind, and here's a word on Trick and Company, the Trick, Trap, Fool, and Frustrate crew. If they're going to make a move, whether it's up or down, in theory, and this is like the conspiracy theory stuff around how the market operates, they have shakeout operations. They really don't want anybody in for the move. Now, they, whoever they is, they don't know. And who is they, by the way? I know I get that question all the time. They is the market. The market is made up of participants. Whether the participants are trading or programming computers, the market is made up of participants. That is the they. But Trick and Company, they don't want anybody in for the move up or down when they decide to finally make the move. That's why you'll hear me and you'll see me print in the notes. You'll hear me say, and I say this to Jordan all the time in the room, it takes time. You have to give them some time. Time is more important than price. First, they want to shake everybody out before doing the thing they're ultimately going to do. Not all the time, but a lot of times. They test, retest, and then they finally make the move. How do we read the XLF chart? It's interesting. It's different than the other charts. Not the downtrend part. That's the same. But we have this big breakup candle from Friday. They're running a test near the lows, not even at the lows. They've gotten halfway, a little more than halfway home, but they're starting to creep down to run a test of the big breakup candle low. So you can see that not all charts are in the same position. And here's what we can say. 31.27 is the breakup candle low. Start getting below that, and it's a whole new bag of worms. Start climbing the breakdown candle from yesterday, and then we start focusing on the high at 32.87, and that's the way that they get this thing moving to the upside, by getting above the high of yesterday. Before that, nothing doing. About Smash Mouth. Smash Mouth, the Philadelphia Semiconductor Index, is a good proxy for the tech space, and they're near the lows. There's nothing bullish on the Smash Mouth chart. The weekly chart is just going sideways, building energy to attack the 200-week moving average. That's basically the setup on the chart. Now, we know it's all the same market. If all the markets are going to get a rip higher, Smash Mouth will get a rip higher. But this is what the chart setup is today. It's bearish, and barring a dead cat bounce, relief rally, rip your face off rally in a bear market, barring that, this is pointing lower. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.